All right, good evening, and thank you all for joining this live event put together by iGlobal Forum. I'm Roger Kowalski, a director at iGlobal. It's great to be hosting today's live virtual experience. Real estate developers don't get crushed by the transition to SOFR. I'm going to let Joyce introduce herself in just a moment, but you're about to hear from one of the country's experts on the LIBOR transition, an active member of the ARC's Bilateral Business Loan Working Group, Accounting and Tax Working Group, and Conforming Changes, Tax, and Term SOFR subcommittees. I'll get to Joyce as quickly as possible, but first I have 3 bits of housekeeping for the attendees today. 1, attendees have the ability to submit questions in real time. So many of you have already submitted questions ahead of this. Thank you for that. Joyce took a look at those questions and took them into consideration when thinking about the flow of the discussion. However, if you move your mouse on the bottom, you can see a Q&A dialog box appear. You could submit questions in real time, and the question will pop up in there, and Joyce might respond to it in real time or leave it to the end of the discussion. 2, we have polling questions for you to interact with at the beginning of this session. Take a moment to interact with those because we really want to tally them up and really kind of display the results in real time. That'll give Joyce some opportunities to kind of gauge everyone's mind on where we all are with the topic and steer the conversation in that area as well. It's also kind of interesting because this is a very important topic that not a lot of people have a lot of questions on. And 3, at 1 p.m. sharp in 1 hour Eastern, we are displaying a new link to click on. You should already have this in your calendar, but if you don't, we'll put the link in the chat box anyway. You'll be brought into a new Zoom breakout room. Your camera and your mic will be functional. This will be your opportunity to kind of raise your hand, and we can call on you to ask a question to Joyce in real time. So this is a group that doesn't get together very often, and let's talk about a very important topic. A couple of you have been asked if it's okay to submit, and kind of ask Joyce that question at that overtime portion. We'll get to those questions and anybody else that has any if the time permits. But that's it for me. Without further ado, I want to introduce my friend and the moderator for the day, Joyce Frost. Joyce, how are you? Oh, you're on mute. There you go.
I think by now I'd get like every button and how to do every single thing, but
2 years of practice.
I know, 2 years, right? But thanks everyone for joining. I hope this next hour is very informative for you. Who'd ever think that throughout my career, which started in the 80s, not to date myself, which I don't really care, it starts with LIBOR and it's not ending with LIBOR. A whole career in derivatives. I'm spending all my time on LIBOR transition, which is great because it's something that's really important to our clients, really important to the market in general. Probably one of the biggest changes that the financial industry will see broadly, not just in real estate, but throughout this country, and for some of you that may know, throughout the world as well. So Roger, you want to ask Marina? There's a couple of questions we want to put out there, just so I kind of have a baseline, because this is a very large audience, which is terrific. And I just want to kind of gauge where you are with your bankers. 1, have your banks reached out to you proactively regarding proactive amendment of your LIBOR-based loans to SOFR-based loans? So that question is not, are you doing new loans, but this is the legacy loans. Have they reached out to you about amending? And then 2nd is really more internally. Have you begun to prepare for the LIBOR transition? I don't mean prepare like you've read a few articles, but have you started inventorying your exposures throughout your organization to LIBOR? So take a few minutes there and answer those. That would be great.
We're about halfway through the people that are here, so maybe another couple of seconds.
Great. This should be pretty straightforward. Yes, no, not sure, or we're on top of it, which would be phenomenal. Sort of, but we want to start doing more. By the end of this, I think you'll be certainly, hopefully not in the last category. No, we haven't even started yet.
Okay, everybody, about 10 more seconds and we can display the results. Can you please?
And there's probably a wide range of banks too. And I say banks, I know there are a lot of just credit funds out there too. So any type of lender, I should probably put lender on there.
Okay, let's display the results here to give Joyce a baseline.
Okay, I'm happy about that. Yes. about half the banks. I'm not happy about the no's because I wish there were more yeses, and not sure. We'll be checking your inboxes because there are several banks who have been proactive, and I don't think there's enough that have been active enough. Have you begun to prepare for the LIBOR transition? We are on top of it. Yes, 48%. Sort of, I want to start doing more. 31. No, we haven't started yet. Okay, 21% of you guys got to take it to task and get going on this. It takes much longer than you think, which I'll kind of sugar in experience that we have so far. Okay, so I'm going to, Roger, close that, and then I'll share screen.
Yep.
We can start the presentation.
Go ahead and close it out, and you're good to go.
Right. Okay, you can see the whole screen.
Perfect.
Transitioning to SOFR loans and hedging. So quickly, I'm just going to share with you Riverside, who we are. Why hedging? In real estate, typically you have to hedge. There's elective hedging, but very importantly, that you have covenants generally that cause you to have to hedge. Okay, there's two elephants in the room. I know this is mostly about the LIBOR transition, but the other elephant in the room is why are interest rate caps so expensive? We'll spend a little bit of time on that in the beginning just to frame out, because I know that's questions that we received beforehand. And then, of course, the LIBOR to SOFR transition. So Riverside, who are we? We're based in New York. We found our firm in 2009. My co-founder and myself have spent our careers on Wall Street. Prior to this, I was with Morgan Stanley. I was with Sumitomo, Chase, always in derivatives. And my co-founder, Chris, used to head up SocGen, or Society Generale's rates and FX for the Americas. Everyone on our team is very experienced. Most of us have had experience on the actual trading desks, which is really important because we understand as principals from the dealers where the banks make money. We know the internal processes, and most importantly, we're very well regarded by the banks because we really know what we're doing. We take a very customized approach working with our clients, and our edges are people. I love our team. We've got an excellent team. There's 11 of us, most in New York, but we've got an office in Boston and in California and in Florida. But this is not a sales job. I couldn't tell you how much I love what we do, love our group, and really like working with our clients. We really work with our clients on the full gamut in terms of hedge strategy development. Sometimes you don't really have to have a strategy because your covenant tells you almost exactly what you need to do. Work with the documentation. We really partner with counsel. We don't hold ourselves out as a law firm. So if there's a full-blown ISDA involved, we'll partner with your counsel. We'll take the lead of negotiating the commercial terms, but we know where our expertise stops and where we really need to rely on the lenders, especially when you're incorporating areas of security in the credit agreement. Price negotiation, execution, regulatory compliance, which in this market, I will tell you, I know you all in real estate do swaps too, but the cap market is very inefficient and not so different from the execution that we all been doing since, for example, the 80s. But the regulatory compliance with the KYC and the onboarding is a heavy lift, as some of you know, and it's such a heavy lift that it really has chased out a number of active dealers in that market because of the competitive bid process, which you probably, for those that are active, probably see as well. And of course, really important for our clients is the ongoing accounting and valuation support. Okay, that's Riverside. So let's just talk about the market just a little bit, because this is a topic du jour and it has been for the last 6 to 9 months or so. So just pointing out here what the Fed tightening cycles are for any of you who have started their careers like post 2008. You probably thought that LIBOR was close to zero for a long time. We creeped up a little bit, 2016, 2018, came crashing down, as you all know, and now we're creeping up rather quickly. For those of you that have been in the market, for some time, 1 or 2% interest rates were not the norm. The norm was really in that 3 to 4%, and got as high as you can see here, 6% plus, and we're really focused here on on where LIBOR was. Excuse me, the top is the Fed funds, and this second is LIBOR, which, as you know, they're very highly correlated. Okay. This graph is really important for many different reasons. So this is called the forward SOFR curve. We're going to talk about what SOFR is. I'm going to hope that many of you at least know that it is let's say market standard replacement rate for LIBOR. But we're looking at the forward curve, which is really derived, it's really just math. It's not where the crystal ball and the economists of the JP Morgans and the Chase and the Cities and whom not predict where LIBOR or SOFR is going to go. It's really calculated based on the very front end of the curve, like the very short-term rates and longer-term rates. So in this case, it's derived by looking at where 5-year essentially swap rates are. The top line, the blue line, is where we sit today. That's where forward SOFR is. SOFR and LIBOR is right on top of each other, so we can talk about them almost interchangeably. We'll talk about why they're not exactly the same. But essentially, as you've been reading in the news, and if you're familiar with the forward curves, and certainly many in real estate are, because when you're doing your pro formas in terms of your base case, downside, however you look at your pro formas, you really should be looking, and many do use the forward curve for SOFR curve or for LIBOR to predict where your cash flows will be and how close you come to your DSCRs in certain stress scenarios. But essentially, it has the Fed hiking probably until mid of next year or so, and then rates, gradually easing and landing at 3.5. But again, if I were to take this curve out to 100 years, that forward curve is going to be pretty much flatline at 3.5%. So we all know that forward curves aren't the best predictor of where rates will go. And let's just look at the forward curve from a year ago, which is the one, the gray line below, where we were flatline at 0. And it had rates increasing roughly to 1.5%. But at that point, who would know that we're in a war? Who would have known that we have a war that is, crushing the oil supply, inflation throughout, and we can go on and on for all the different reasons, but the forward curve is often not correct. Meaning that the forward curve, the blue line, it doesn't mean that rates are going to peak at 5. They may, but that's why we have volatility, and that's why we have different expectations on rates can go, because they can go much higher than 5. And the terminal rate, meaning Fed funds rate, may be calling for 5.5%. Certainly the Fed, and we'll see this tomorrow and the day after, they're certainly going to be raising rates by 75 basis points. They don't like to shock the market, but it'll be very interesting to hear what they're going to do in December, which is the next meeting, and whether that's 50, which is what the market's pricing in, or it's 75 again. I drew the 3 red lines here, the horizontal lines, because 3, 4, and 5% are the typical cap strikes that have been in covenants literally since I can remember. We didn't see cap strikes by banks and lenders and mass, even when we were close to 0, they weren't 2, 2.5. They generally were 3, 3, between 3, 3.5, 4. So let's talk about the price of caps. Actually, I was quoted in the Wall Street Journal a week and a half ago, from Friday, exactly on this topic. And it was focused on the real estate developers, how expensive, not just developers, but real estate investors, how expensive interest rate caps have gone. So again, I'm looking at this 3, 4, and 5%, and why they're so expensive is because at least over the next year, we have a very steep curve, right? And if you need to get a 3% cap, that's considered very in the money. So it's very, very expensive. The curve is inverted and starts going down, but that still is quote unquote in the money at the 3%, and still makes your 4% caps very expensive. Another reason, go back to, if any of your, I think many of you are finance folks, go back to your options classes that you may have taken. There's 3 components that are going to drive the cost of a cap. One is the strike, and this is any option, so with your options on equities. The second is the exercise date, how long and what's your time value. And we talk about a cap, an interest rate cap on short-term SOFR or LIBOR. It's a series of little caplets. It's little series of options throughout 2 years, 3 years, 5 years on where SOFR will go relative to the strike. So there's time value. That's a second. And then volatility. What's your volatility input? Because if volatility were at zero, we would know exactly where the forward curve is going to be, and we can exactly price that option. But rates are volatile. And in this market, one of the reasons why rates are, or cap prices are so high, is that the input volatility is very high, somewhere like 120 to 140%, depending on your strike. So that's an input. And it used to be a couple of years ago, I'd say 60 to 80, which still sounds very high. But it means that when you're pricing options, if you think about it, the higher the volatility, the wider the outcome of rates. So if you look at stress scenarios like 1-2% standard deviation, you'll start seeing that in the stress scenario, that 5%, forward rate on a stress basis is probably like 7 or 8%, given the high volatility. So that's one reason why, or three reasons why caps are so expensive. So what can you do to reduce costs? And let me, before I go there, let's look at the history. If you look at the table below here, we looked at a value date, meaning like we went back on Halloween last year. We priced that straight, same 3, 4, and 5% cap for 1, 2, and 3 years. Okay. Well, of course, it's going to be less expensive because it's so out of the money, right? The truth still holds that you still need to, 1, replace the cap if your cap was maturing at the same strike, 2, buy a new one if it's a new transaction. But you can see even from last August, this past August, how expensive they are now. So for that same, let's just look at the 5% since it's out of money, because of vol and because of volatility, and the curve is steeper, $354,000 right now. Now this is on $100 million notional amount. This is a very wide audience. So some might say, oh my gosh, we'll never go $100 million. And some of you might, oh, that's our average. And some of you, oh, that's small because I'm at $1 billion. Our clients are the whole gamut, tends to be more, a little bit larger generally, but I'm just using this because you can scale the 100 million easily on a pro rata basis on your amount. I said the 3% was in the money. Well, it was really out of the money a year ago. So if you're lucky enough to buy a 2-year cap at 87,000 2 years ago, and I say lucky, these are hedges. It's not like off to the races or off to Vegas. That cap today, if you look at 10/31/22, that same 2-year cap would cost you $3.4 million. Okay, this gets a little tricky. I don't need to go to the details, but if you bought that 2-year cap 87,000 last year, right now it's worth about 1.9 million. But what can you do to reduce costs? I know we're going to talk about the transition, but this is how we're working with our real estate clients right now. And we're being forward looking on it because there's some replacement caps, there's maturities. We're working with them on the whole transition. So we're digging back into those credit agreements. If you are renegotiating the credit agreement now for LIBOR, SOFR, anything else, let's renegotiate that cap strike, assuming your cash flows are fine, assuming your DSCR is fine, from 3% to 4.5 or 5, or whatever will make your lender comfortable and accept, obviously, the negotiation. You can certainly shorten the maturity of the cap. You may have a to maturity, meaning 3 or 4 year requirement, but you may be able to buy a 1-year cap and then, promise via covenant to replace that cap over time. It may not be it may not be less expensive. It will be less expensive because it's lower, the time value is shorter, but we might be in a higher rate environment. So a little bit riskier, but you got to come up with that money in terms of buying the hedge today. And if that's not available, or if the equity, that you put to work to buy that is not available, that's another. We hear this, and actually we got a question on this before the start is, what about buying a lower strike and higher and selling the higher, buying a lower strike, meaning like, what's my a rate in which the dealer will pay me if SOFR were to go above my strike of 3 or 4 or 5%. So for example, what if I were to buy a 4% for 2 years? That would cost me $1.9 million. And what if I sold one? Now, you're not be able to do that in the same legal entity if there's a covenant, but maybe the legal entity above it, meaning a holdco or a fund level. If you sold the 844, So economically, you're really protected between 4 and 5. We have seen some clients and seen some interest in that. There's some regulatory issues you got to kind of flush through on whether you're a financial end user or not, which require collateral. Gets a little bit in the weeds for some of you, but you need to be a little bit thoughtful, and it certainly changes the risk profile. We've even seen, buy and sell at the same strike. So within the SPV, or I call it SPV, within the LLC that holds the real estate, you buy what you need to, for example, 1.9 million for 2-year cap, then you sell that, at 4%, you sell that 4% above, because from a risk management perspective on a consolidated basis, you may be comfortable with where rates are going or your ability to service that cash flow, but you also need to service your covenant. Another area that we're seeing and working with our clients on, and we've seen this from some of the banks because they are so expensive. What about an increase in the interest reserves or interest rate cap reserves? Meaning that I'll put the money aside, okay, or I'll put more money aside in terms of increasing my interest reserves. And should I never need the cap, because if it's out of the money, rates may never get there. At least I can get my money back, meaning like my money that's sitting in that interest reserve back. Whereas the option, when you buy the cap, rates are low, you never needed it, you're obviously not going to get that premium back. Okay, so I wanted to spend time on that because it is really hot topic. It is really expensive, and happy to take questions afterwards with you on that. Okay, so now the topic du jour. I will say I've updated the slides, but these are about the same slides that we've been using for our Riverside webcasts and other webcasts have been given in the industry. Literally, I think for the last 3 years. Same questions, same answers. One, and these are the questions we're going to answer. Is LIBOR really going away? The answer is yes. Okay. I'm going to caveat that on the next one. What is SOFR, and then how do you prepare? So by the end of this presentation, I'm going to hope that you can all, feel much more confident about those answers, and then doing your own internal teaching or calling us to help with that. So there is a lot of LIBOR exposure in the market. Okay, it's not just in the US, but it's globally. So what the regulators did, going back last year, and if any of you have been in the market, which is probably a lot of you, for new transactions this year, the regulators really strongholded all the banks, okay, and not just the Fed, but the OCC and all the regulators. No new LIBOR loans after December 31st, 2021. Even if you amend a loan to extend or increase the outstandings, it had to convert to SOFR. There have been literally, I don't have the number handy, so I'm sure it's over $1 trillion of new SOFR loans to hit the market, not just in real estate, but corporates, project finance, any type of borrower. The banks were not allowed. So the reason why they did that, even though June 30th, 2023, I hope you all know that date because it's not so far away. That is when the regulator of LIBOR, that's LIBOR's administrator, which is ICE, which is part of Intercontinental Exchange, New York Stock Exchange, that the regulator, FCA, which is akin to the regulatory bodies here, will no longer compel, I believe there's 18 banks, to submit their, I'm going to call it guesstimate of where LIBOR is, or euro dollar transactions are trading in the market. They'll no longer be compelled to do that. Essentially, the regulators want to get as much LIBOR exposure cleared out as possible, which is why they turned off the LIBOR spigot and turned on the SOFR or recommended SOFR for this year, because that really did put a good dent on it. The only thing that I'm going to mention about June 30th, and please nobody take this as this is what will happen, this is what will probably happen, because if you remember, the date has already been pushed out once. The Fed is not going to push that date out again. Okay, meaning they're not going to say, okay, forget June 30th, 2023, it's now going to be 2025. It may be that although the banks will not be compelled to have the LIBOR administrator publish, I don't think any banks will proactively give, but ICE, the administrator, may publish a rate that calls LIBOR, but behind the scenes, it's not where those 18 banks submit, but it might be where SOFR plus the credit spread adjustment is for 1, 3s, and 6s. That's called synthetic LIBOR. They did that in the UK, although it wasn't decided upon until a year from now. I know that I mentioned that this is global. So sterling LIBOR changed over a year ago. Yen LIBOR there's all these new risk-free rates now that have taken over over LIBOR. But there is a possibility that after June 30th, that a rate will still be on that Reuters screen that's noted, but it may not, you can't rely on it, meaning we'll talk about that when we start to talk about your loans, and it certainly won't be forever. They'll be doing that. Okay, we allude to the ARC. That's the Alternative Reference Rates Committee. It was a committee that was convened by the Fed, like I think in 2015, 2016, with a lot of market participants. It's almost embarrassing how many different committees I'm on. But the reason why I really wanted to become a subject matter expert because of how much I understand the derivatives market, how much I understand the cash markets, and how important it was for our clients. I also found that in the first couple of meetings that I sat on, frankly, there was more discussion by the, we are the buy side, meaning we're the end users. There's more discussion being led by more of the banks. And I wanted to make sure that borrowers broadly had a little bit more commercial advice or commercial say at the table. But it's been like fantastic in terms of working on those different working groups and committees. So the ARC recommended, as many of you know, certainly if you've had any new loans, because it was really adopted widespread starting in 2018, 2019, there's two approaches that became an integral part of a standard loan agreement. One was the amendment approach, and the other was the hardwired approach. And there was very specific language and very specific definitions in both amendment approach and hardwired, and also in ISDA, which I'll talk about in a bit. That once certain benchmark events happened, or once certain benchmark event is the transition event is the name of the term. Once certain things happened, other things will happen in your credit agreement. So, for example, the amendment approach is exactly what it sounds like. Once these certain events occur, depends on what is in your agreement and what you negotiated. The borrower and the lender will agree to amend your credit agreement to replace LIBOR with a market recommended or ARC recommended rate plus a credit spread adjustment, which I'll talk about in a bit. What's important about that, and I know many of you probably have bilateral loans, so amendment approach, it's going to be 100% consent, it's just you and the lender. But any key economic term in almost all loan agreements, whether it's like a money term, whether it be the principal amount, the maturity date, or interest rate, typically requires 100% consent. And we know that that would have been impossible in the market to get 100% consent switching from LIBOR to SOFR or whatever the replacement rate is. So the amendment approach typically only requires the required lenders. And for many of you, that required lenders, this could be more than 50%. For some of you with 2 or 3, it might be 66 2/3. We see that as well. So the amendment approach, the borrower, lender, or admin agent come together, agree, and then you go out to the market, or you go out to your lenders. Some of my deals are really broadly syndicated. You go out to the lenders, and there's a 5-day rejection. So it's a negative consent. So if someone's asleep at the switch, right, meaning not the admin agent because they're doing the process, there's no negative consent. You just have to have less than 50% required lenders negatively consent. The hardwired approach is not so obvious, but hardwired means that as long as these exactly defined transition events happen, we don't have to amend this agreement. And this is what we refer to as the waterfall. If LIBOR is no longer available or no longer representative, that's going to be the key, is no longer representative. Then what's first on the waterfall? Term SOFR was typical. Daily simple SOFR will go through. So as long as term SOFR is in the market, term SOFR plus the ARC recommended spread adjustment, which I'll talk about in a little bit. So you don't have to do anything. And then we're going to talk about SOFR and what is SOFR. Okay. It's, I always say this, and this is how you're going to remember it. SOFR is pronounced like gopher, and it's not so far, meaning I've heard that before, like, oh, what about that so far rate? Well, you're going to know SOFR, like, you know, LIBOR. And if you have multi-currency facilities, or if you invest in other areas, you're going to know Sonia, Tonar, Tonia. There's all these crazy little names now because it's not consistent like LIBOR, but they all are risk-free rates. SOFR, which some of you may know, I'm going to just spend really quickly on this. It's based basically on overnight repo. And why overnight repo was chosen as like the base for the SOFR rate. One of the SOFR rate has been published for years now. The repo market has many market participants. It's not just the banks, it's insurance company, hedge funds, pension funds, because it's where they borrow and lend securities and cash on a secured basis every single day. There's trillions of dollars of actual trade data, whereas, for example, 1-year LIBOR, let's just guess there might have been 50 million or a billion, and you got trillions of dollars of transactions being priced off of 1 month, which is much more common, obviously, in the euro dollar market than 3 month, 6 month. There might not have been any trades. And again, it's secured because it's secured by treasuries typically, versus LIBOR, which is an unsecured rate. It's a promise to pay between banks and the euro dollar market. Okay, why this gets confusing, and I'm not kidding, and this is a bit of a challenge, is that there are, I would have told you 2 weeks ago 4 SOFR alternatives, but I just learned of a 5th one. So let's just go over the different alternatives. Well, we're going to do it in more detail, just running them down. Daily simple SOFR is used quite a bit in loans. Daily compounded SOFR is the ISDA standard, meaning the derivatives, the interest rate caps, interest rate swaps. That is the standard in the traded market. Then there's what we refer to as term SOFR. Term SOFR is a licensed product by the CME Group, which is Chicago Mercantile Exchange. And they've been publishing SOFR for, I believe, about 2 years or so, but it was formally recommended by the Fed in 2000, by the ARC, sorry, the ARC in late 2000, July 2021. We see loans and swaps. Now, what I just learned last week at a conference, there's another term SOFR, which is the ICE. Now, remember I said ICE is the administrator of LIBOR. Well, ICE gets a lot of licensing fees. So once LIBOR really goes away, that fee goes. So I guess they just came up with their own ICE term SOFR. I haven't seen that in any loans. I haven't heard any discussion, but I did hear that at a conference that I was at, and I actually went to their website and they do publish it. I don't know how much traction it's going to make. I don't know that much about it, other than it's probably very close to term, but CME term SOFR is a license requirement, but as a borrower, you don't need that license. But from what I understand, the license definitions are pretty broad. Okay, the last one, which I have seen in some real estate deals, is called the compounded. Just think about it as the SOFR average. We usually see it defined in credit agreements as the SOFR 30-day average, or 90-day or 180 days. So this is actually a rate that's published by the New York Fed every day. And it looks to see where daily SOFR has been, or daily compound has been for the last 30 days. So we're sitting here now, it's November 1st, who can believe that? So they'll look at where has SOFR been for the last last 30 days, and that'll be the average today. Now, where people are using that, and where borrowers and lenders are using that, that is the rate that's going to be set for the interest period, in our example, November 1st to December 1st, even though it reflects rates last week or last month or last 90 days. Where we see this used more is intercompany loans, which doesn't apply to real estate so much like other companies. You don't need the licensing requirement. There's no funding, generally between intercompany loans. But I have seen that. Now, what it does mean, and I'm gonna go through this in more detail. Okay, let's go and dig into the details here before I go into daily, the 30-day average. Okay, daily simple is what you'll what you will see, and we do see from time to time in the loan market. It's recommended by the ARC and the hardwire, although it's typically second after term. For some of our clients that have swap requirements, we flipped that in the ARC hardware. The reason being, and let me address that when we talk about the swap market. It's published every day by the Fed. During the interest period, if you have daily simple SOFR, one of the reasons why it hasn't taken off as much as term SOFR is that if you have a 1 month interest period, it's where daily SOFR is today, November 1st, every day until the end of the interest period. And then interest is paid either on that date or oftentimes in real estate, like the 9th of the month. But because borrowers typically don't like to find out like the day of, the day before, they just operationally can't. There's typically called a cutoff or look back, where the rate won't be observed today. It will be 3 days ago and 3 days before the interest period, and then you'll know in advance. On October 27th, the rate was 3.04. Daily simple is going to follow the Fed, where Fed funds are very closely. Now, tomorrow, this is what's going to happen. Tomorrow. So the Fed's going to increase by 75 basis points, and then SOFR is going to get print and it's still going to say 3.04. This is what happened a couple months ago. So I get people calling like, why isn't SOFR moving? Rates just went up. You're going to see it the next day. Because it'll follow Fed funds, as soon as you see Fed funds increase, which would be then, I believe, on Wednesday, the 3rd. All right, daily compounded, everyone knows what compounded interest is, but this is the swap market convention. So any type of interest rate cap or swap that's traded between the dealers, and then oftentimes too, will be used by end users like yourself. It's daily compounded. But you're saying, well, wait a second, but how can I have daily simple on my loan? You could do daily compounded on the loan too, but there's really not so much of a market. And if you look at the number of pages it takes to define, you're going to get math formulas like this big. So if you're receiving daily compounded on your swap, by definition, by math, it's always higher than daily simple on the loan. So you're going to be better off. There's no real accounting issues with that. They're so highly correlated, obviously. That compounding has more an effect for in higher rate environments like now, but it's minuscule. But again, it works in your favor. The same with the caps. Okay, I think I covered everything here. Okay, I'm going to talk about term SOFR, and then we're going to go back to the hedges. So term SOFR was recommended first in the waterfall for the hardwired approach. And term SOFR, in terms of its operational mechanics, look very much similar to LIBOR, meaning it's set 2 business days in advance. It's not set, but in the credit agreements, you observe 2 days before the effective date. Then that's what your rate is. For this example, 30-day SOFR is 376. Between today and the end of your interest period, and then in advance by 30 days how much you're going to have to pay on that payment date. So mechanically, it looks very different. But again, it reflects a risk-free rate versus a risky rate. Why term SOFR is different, you're probably looking here and saying, oh my gosh, that's 376. Wouldn't it be cheaper with daily SOFR at 304? But term SOFR, think of it this way, is the market expectation of daily SOFR every day for the next 30 days. Okay, so because in this month particularly, it's been so out there that the Fed will be raising by 75 basis points, that's already baked into the term SOFR rate, going back to right before, that 30-day would have cut off to cover the increase. But it's the expectation of where daily SOFR will be over the 30-day. I put 90-day here because you can just see it's not a term structure of rates, just like LIBOR's, there really are increased borrowing costs if the borrower's going to borrow 30 days versus 90 days. This is really baked into the amount of rate hikes and in the timing of what rate hikes between now and the next 30 days. Term SOFR, really importantly, term SOFR in the swap and derivatives market is not as liquid as daily compound, meaning that your pricing is going to be wider. And for swaps, it's going to be somewhere between, on the tight side, 2 basis points to generally 3, but we've seen some banks, I'm not exaggerating, as wide as 10, wider. And the reason why is that in an effort to create more liquidity and more volume for the SOFR futures markets, just like there's Eurodollar futures, there's SOFR futures. In order to create liquidity, the regulators, quote unquote, not legislatively, but prohibit the banks from entering into term SOFR transactions with each other. Okay, so a dealer to dealer can't hedge their book by entering into a back-to-back with term SOFR. I got to load off this risk. They can only enter into term SOFR trades if an end user has term SOFR exposure. So if you have a term SOFR loan and you want a term SOFR loan, you can buy a term SOFR cap. They're going to be a little bit more expensive, but you can buy a term SOFR cap. The same thing with a swap. But what we advise our clients, certainly if there's hedge requirements anywhere 75% or greater, is to enter into a daily SOFR loan and a daily SOFR swap, or really the compounded swap, because that is very hedgeable and you're not going to pay that extra 3 basis points. Derivative, if you've been working with derivative ourselves or others, derivative folks on the trading desk, we think in terms of basis points because we think in terms of the present value of a basis point. Some of our transactions that can be very, relatively small, like $25,000, the present value of 1 basis point over the 3-year maturity. Some are $1 million plus. So those 3 basis points make a difference because of the mark to market, the valuation, and the accounting for such. But right now there is a restriction on banks offering term SOFR and their ability to only those participants that have the exposure. And it just forces the bank to manage the risk associated with the way it hedges itself, meaning the SOFR futures market and the desk. So that one bank, I will not name the name, they're a large, pretty large dealer. There's just so much risk that they can take without being able to lay it off. So that's what they are saying that their charges are. I started to mention the compounded SOFR average. I'm not going to spend too much time on it because we don't see it that much. That is the backward looking rate, what rates were the last 30 days. In a rising rate environment, you're going to be better off on that up until the point where rates flatten out or go down. Okay, so it really just tends to be then more of a timing difference, and what ultimately is the difference between your first interest period and then your last interest period. You got to be really careful because I've seen some, I just want to call it some mess ups where a client was borrowing under 30-day average, but bought a cap based on term. So they're not matched and wasn't as thoughtful as it should have been. Certainly wasn't our client. And we're just trying to fix that. Now I'm really focused on SOFR. I'm a free markets person. I'm a University of Chicago person, so I'm a free markets person. There are other indices out there. So BSBY is the Bloomberg index, right? And a Maribor. So BSBY we do see from time to time. There's a handful of banks, I believe, Comerica, PNC, and it used to be Bank of America. I don't see them as much anymore, that will offer BSBY. And why some of the banks prefer BSBY, because it's a credit sensitive rate, meaning that its rate looks more like LIBOR, not just in terms of the 30 and 90 days, but because it reflects banks' credit in the market, okay, which is lacking then on the SOFR side. And Maribor, we Riverside, we hardly see it. From time to time we do. I do see it in real estate sometimes. It's usually by smaller community banks. Maribor is a fairly robust market where regional or community banks fund themselves. So, quite legitimate. We just, don't have that many clients on that. And frankly, the swap and the cap market certainly would be nowhere near as liquid to get really good pricing. Okay. So let's just look at the before and after and what these credit spread adjustments are. So on March 5th, 2021, I mentioned the amendment approach. So the amendment approach alluded to a spread adjustment, right? That was recommended by the ARC or based on market convention in this, like however you defined it in the loan agreement, syndicated loan market, real estate syndicated loan market, real estate market, what have you. And the reason why there is a spread adjustment is because there had to be, some mechanism or some, well, mechanism is probably the right word, but there had to be some adjustments because SOFR is lower than LIBOR. And it's lower for two reasons. One, it's a risk-free rate, right? Versus a risky rate. But the part that people really don't talk about in the market as much, and I wrote a white paper that's on our website, you can read because it goes over the history and I think has some good information on these spread adjustments, is that the ARC spread adjustments really had to reflect ISDA spread adjustments. So they're identical. And the ISDA spread adjustments, and there was a lot of market consultation on how do we come up with a rate that over time is favorable to the, in this case, the payer and the receiver of fixed versus floating, borrower and lender. So they agreed on the 5-year historical median difference between a LIBOR rate and overnight SOFR. So this rate was set permanently on March 5th, 2021. That's when the FCA made the big announcement that LIBOR will no longer be representative after June 30, 2023. So that permanently set it. And it was important that it permanently set that because we knew what SOFR was. We didn't really quite trust it yet, because if you remember, there was something called the SOFR surge, which I think was like 2019, quarter ends, because balance sheet dressing, there was some stuff, but SOFR has been very calm, very reliable and predictable since then. But there had to be some kind of adjustment. So they set these rates, and why I said is based on two factors. Is one, everyone only talks about unsecured versus secured. But the ISDA, in swaps, it's either 1, 3, or 6 month LIBOR, typically is your floating rate leg. Now that's going to be replaced with an overnight rate, overnight compounded. So those spread adjustments are also based on the difference, the 5-year median, between a 6-month rate and an overnight rate, a 3-month rate and an overnight rate, a 1-month rate. So if you were in a very flat curve environment, those spread adjustments would be very low. If you're in a steeper curve environment, in the short end of the market, it's going to be wider. But the SOFR spread adjustments were set. And for 1 month, and I'm focused on 1 month because most real estate loans are all 1 month. I very, very seldom see 3s. The SOFR spread adjustment is 11,448. The hardwired approach, you don't have a choice. You already agreed with your borrower. You're going to replace your loan with term SOFR, right? Or possibly daily SOFR, depending on what you put in. Plus 11.448, no negotiating on it because it's already set and done. The market has evolved though, and read the white paper because there's a lot of different reasons and a little bit of history going back 1 year now on these spread adjustments. And that is when we're working with our clients, when we're negotiating the amendments for the legacy loans, there's 2 commercial factors. That's really commercial. What type of SOFR index and what is your credit spread adjustment? The market spread adjustment for 1 month periods, like there's 1, 3s, and 6s. But again, I'm focused here on 1. Typically is 10 basis points. I sometimes see 11.4, even though it's an amended loan or a new loan, means we're probably not getting the greatest advice. You guys are thinking, oh my gosh, it's only 1.5 basis point. But for some of our clients, that's big numbers, or it's important. They want to make sure they're getting a fair market deal. So it's 10 basis points or lower. We have seen some zeros. And you've probably already seen it, but these spread adjustments, are and should be going away at some point, because you don't need your SOFR plus 250 plus 10 to get 260. The term sheet should all just come out and say term SOFR plus 260 if that's what I need, or term SOFR plus 250. So I think we're going to be in this transition period where the market for new deals are still pricing, and certainly any deals that need to be amended. So what's going to happen on your loan? You were at 1 month LIBOR plus X meaning your applicable spread, credit margin, loan margin, whatever you want to call it. And now it's going to be 1 month SOFR plus bracketed 11.448 plus X. I want to make very clear to everyone, and I have in the market, and there's certainly more acknowledgement of this between your banker, is the ARC spread adjustments. They announced publicly in their consultation quite some time ago that these spread adjustments right? Are not intended for new contracts. Okay, like the 3-month, by the way, is 26. And if you have 3-month interest periods, might, but I don't see that so often. And 6 months is like 46. The market now, again, is 10 for generally 10, 15 for 90-day and 25. But we've been getting with some of our clients 10, 10, and 10. Not so much in real estate, but in the corporate market, a lot of markets, the borrowers have the right to choose between 1, 3, and 6 month credit spreads. Okay. The only issue that we're coming with today is just based on where term SOFR is relative to the historical credit spread adjustments. It's a bit more expensive. So just using the October 26th is term SOFR plus CSA is credit spread adjustment. That's what it's referred to in the market. Where 376 plus 10 is greater than today's LIBOR setting, or I'm sorry, that same day of 375. So it's a bit more expensive. So you're probably thinking, okay, well then why don't I just wait? And I'm going to tell you why in a little bit, why you should not, or not even think about it. So sorry guys, I just saw a typo here. Between January 6, 2021, an infamous day, of course, unfortunately, 2021 to October 28, 2022. Just looking at this time, I know, Roger, 10 minutes. I had my little thing go off. The actual average has been only 6 basis points, where the median has been 5. It's kind of odd. We don't see market spread adjustments. It's either 0 or 10. We have one client, project finance, we got 777 done, and that was done like last December. But because even the market spread adjustment of 10, which is less than 11.4, is off to where these were, compared to the current market. I think that gives you a little bit of negotiating power. I like to start seeing some of these deals get done at 7, if not 5. In the market. I'm just focused right now on certainly the LIBOR transition. There's a lot going on in the lending markets, just generally with potentially likely upcoming recession. There's bigger fish to fry and some other things, but the transition for many is an important factor. The reason being, and this is why hopefully you're going to be getting all this up on your to-do lists. So where we are right now is LIBOR is going to be here until June 2023. Your hardwired agreements, you really don't need to do anything with because they're already there. Your ARC amendment approach, you do. And if you have loans predating ARC, you really got to focus on that because they didn't have this set language. Now, most credit agreements have, inability to determine LIBOR, or there's always unfair LIBOR, unfair SOFR, that's going to stay in there. But we have this window of time up until it's published that we're in the safe zone, but where we're not in the safe zone is this orange area. After June 30th, so June 30th will be the last date. So June 30th, we'll have your 1-month LIBOR published. So it's really, after July 1st, depends on when your interest period is. But after this period, contractually in most loan agreements, unless you were ahead of the game, like some of our clients that we work with, where the fallback is not base rate, something else like Fed Funds Plus, but in almost all your agreements, the fallback is prime. That's a problem because one, we're already in a higher rate environment. Your increased costs, because of when LIBOR is no longer available or it's not determined, you're going to be put into base rate, which is prime, and depending on your credit agreement is structured, it's either going to be 2 to 3% higher. Now, when we're working with our clients, we also look at all the DSCR definitions because they're all over the place, right? But we would really not like to be in a position where we're in prime, and just because of this prime area, not that the covenant wouldn't be waived, but that we're triggering DSCRs, right? And having technical defaults. So we want to avoid this by all costs. And then by all means, then we have the, after it's transition, then we're fine, we're in SOFR land. But what is taking so long, and I can't even underestimate this, it is taking so long to get these amendments turned by the lawyers, and there's no finger pointing at lawyers specifically, And we're when I say just starting, some of our clients, we've been proactively working on engagements for like a year. So they were in SOFR loans like a year ago. But just starting right now, the process of proactively amending those ARC amendment or predate is, we'll go through, we'll look to see exactly, what the provisions are. And then the lawyers will typically take, the common approach to amendment. Lawyers will look at it, they'll do a black, red line, blue line, whatever you want to call it, black line throughout the agreement. It'll then go, well, it could be lender's counsel that starts it or borrower's counsel. Okay, typically the lender's counsel will start it. Then they'll send it to you and borrower counsel will look at it. They'll do the track changes. They'll take that back. They'll send it to lender's counsel. So it takes well over a month, and I'm not exaggerating. I think one or two we've done, I'm like hitting them, like we got to get this turned a lot quicker. That it is just a very inefficient, long process. That's just one deal. Multiply that by thousands and thousands and thousands of agreements all throughout the country. There are some banks based on, you might be familiar with the association, it's called LSTA, the Loan Syndication and Trading Association. They put out a sample form of amendment, which is like 5 pages, and it kind of does the trick, but it's not this bespoke approach where there's red line throughout the agreement. I've also seen, which is frankly quite irritating to me. Remember I told you about negative consent? So if you're set up with ARC, there's negative consent. You just have 50 people, or whoever, 50 lenders, 50% of the lenders disapprove of the loan. Well, some of the banks are adding new provisions in the agreement that changes the process from a negative consent to an affirmative consent. That's a problem, especially if you're doing something more aggressive like the 10-10-10 I spoke about. Now in real estate, it's really just one credit spread adjustment. And again, many are bilateral, but you just got to be very careful of what's getting slipped into the agreement. The other thing I want to mention too is it is a little bit more strategic in nature in terms of how you go about your process, because for some of you, you may not want to open up your credit agreement right now because maybe things aren't going so great, or it gives the bank the opportunity to, hey, let's slip in this, or let's tighten this, or what have you. So there is thought going into, and certainly what your hedge is and what makes the most sense. So there are different decisions to be made. Let's talk about hedging for a second. I already talked to you about hedging about with the different indices, but essentially we swap people like boxes and arrows because it makes things really simple. And these boxes and arrows work the same whether you have a fixed rate swap or a cap. The fixed rate is really your upfront cap premium. They agree to pay you, LIBOR over time. LIBOR is canceled, but you got to pay the lenders. Forgetting about the applicable margin for now. But post conversion, what's going to happen whether you have a cap or a swap? That LIBOR leg, that 1 month LIBOR leg, will become compounded compounded. So if you do nothing, compounded SOFR plus the 11,448, right? Now, if you're a swap, that's what they'll pay you every month. And you're either going to be paying, depends on what you're paying on the loan side. Or if it's a cap, you're floating until compounded SOFR plus 11,448 exceeds the strike. Now, I just want to point out here that if you executed any of your swap cap transactions after January 25th, plug for my daughter, it's her birthday, that's how I remember the date so well, 2021, or afterwards, if you do nothing, you don't fall back to prime like before. I know, Roger, one more minute. What you do is you fall back to this compounded SOFR. You possibly can take the mismatch. I'm on the last page. You can possibly take the mismatch. You can negotiate, depends on how I'm reading through every single one of our covenants with our real estate clients. What does the covenant say? Most of them only refer to strike, notional amount, and maturity, and not necessarily to the index. So you might be able to take that basis risk. It's up to you. So the next steps is look at your portfolios, look what you have. If you have multiple properties, this is not an easy task and it's going to take a while. Engage with your banks in terms of dialogue. Determine what is you know, most important for you, the term SOFR, daily SOFR, what do your hedges look like? The only thing I can tell you for sure, and I'm not being a sensationalist here, I can't even underestimate it. Do not wait until first or second quarter if you can, if you can help it. Everyone's got huge to-do lists, but get it up there because you're not going to be. Everyone's saying, "Oh, I'm like some of my bank's favorite client to my lawyers. We pay them so much money. Of course, they're going to do that." Well, so is everyone in the world asking at the same time. So get ahead of it. And you know, I think I covered all this, you know, existing swaps and caps and mismatch, and it's a little more complicated, unfortunately, than it needs to be. All right, we have one last question, Roger.
Well, we have 3 in the chat, but what we could do right now is we're at 1 o'clock. What we're going to ask all of you do in the audience is to click on a new link, which we're about to put into this chat. There you go. Or it's in your inbox, but be camera ready because your camera will be on and we have an opportunity to speak with Joyce. Oh, there's a polling question. Let's run this polling question in overtime so no one gets confused. Marina, is that okay?
Oh yeah, whatever.
Oh, actually, you know what? We're already there. There's many people answering.
So after joining today's 1-hour webcast, do you feel better prepared, more prepared? Yes, absolutely, a little bit. No, I could definitely benefit from more information, or I should put a last one. Oh my goodness. Why have I waited so long?
Well, I'm seeing things come in real time and I'm seeing no no's.
Okay, good. Great.
All right.
I know, sorry, it's the 5 SOFR, the 5 different, now let's just call it 4. We'll get there, whatever. The 4 different SOFR choices, I think, and the spread adjustments and what do we do? That's it's going to be the confusion in the market. So, okay, see you in a little bit.
I'll see you in the other side.